morning. This is Horizon's Middle East and Africa, our top stories this morning. Oil prices retreating as the U.S. and Israel try to ease concerns over the war with Iran. Prime Minister Benjamin Netanyahu says Israel will avoid future attacks on Iranian energy facilities. QatarEnergy says the strikes on its Ras Laffan site will cost about $20 billion a year in lost revenue and take up to 5 years to repair. And high energy prices are reviving fears of a global inflation shock. Bond investors worldwide now rushing to price in higher interest rates, complicating the path ahead for central banks. Well, it has just gone 9 a.m. across the Emirates. I'm Jumana Bersachi in Dubai. It is day 21 of the Iran war, but I'm going to put that aside for 1 second and just wish our viewers who are celebrating Eid Mubarak and hopefully more peaceful days to come in the coming days. But with that, let's take a look at how global markets are faring. The handover from Asia today, somewhat more positive. As you can see, S&P futures leaning towards the green. This is after pulling back more substantial losses yesterday in the session. At one point, we were down 1%, but we ended the day down 0.3%. Anyone who's micro-watching the moves in the S&P will note that we actually did break through that 200-day moving average to the downside. So it could be a key technical level to be watching over the course of the next couple of days. European markets also seen opening up in the green today, up 0.6%. This is contrary to yesterday's price action. We had deep declines on these European indices. The stock 600 ending the day down 2% lower, of course, paying close attention to that massive shock that we had in European gas futures on the open yesterday after the announced disruptions at QatarEnergy, huge supplier for the LNG market. And we had the ECB too, steadied the course there, but Bank of England surprising the market with a bit of hawkishness. I'll get to that in just a moment. So where is oil with all of the developments over the last couple of days? $107 is where we're tracking right now. So net still higher from where we were 24 hours ago. And of course, there have been several attempts from President Trump and even from Israeli Prime Minister to say that they will no longer be targeting Iranian key energy infrastructure. But at the same time, the market is still very focused on the fact that the Strait of Hormuz is still effectively shut, and the damage that has been sustained at some of these major energy facilities in the region, that is not something that's going to be fixed overnight. So we'll have longer term ramifications for the market. We'll talk about that. Gold this morning up 1.4%. But interestingly, as we started to talk about yesterday, what's been happening, precious metals, industrial metals have started to come off on back of some of the demand destruction that's being priced in. And then also some reporting suggesting that central banks, remember, Asian central banks have been big buyers of gold. Many of them now are looking to preserve some of that firepower because they have to support their currencies. So placing less of their money into gold reserves, into USD, and actually keeping some firepower in case the dollar continues to strengthen, which would weaken some of those EM currencies. So that's one development to think about. But I mentioned ECB, Bank of England. We had a slew of central banks in the last couple of days as well, Bank of Japan too, and the Fed and SNB. Let's switch over and take a look at how the reaction has been. And here, let me just show how much front-end yields have moved. This is UK yields, US yields, and German yields. And you can see the white one is the UK one. We've moved 80 basis points higher, 80 basis points higher over the course of this month. In Germany, the move is about 50 basis points. In the US front end, we've moved about 30 basis points, suggesting that the market really is accounting now for sustained higher inflation in the short term. And then switch over, not just that, but also a reaction function out of central banks that would imply more hawkishness. Take a look at this. Now, as things stand, the market is pricing in almost 3 hikes out of the Bank of England for this year. 3. Almost similar for the ECB as well, about 60 basis points of hikes priced in. But the Fed, the market's still holding on for a Fed that stays the course or somewhat maybe tilts towards a rate cut towards the end of the year. So ECB, Bank of England, at least as far as market expectations, now going to start a rate hiking cycle. This is just what market participants are saying. I thought that was interesting to flag. Okay, let's go back and talk about some of the price action in Asia, though. Min Min Lo is in Hong Kong for us. Min Min, walk us through the Friday trade.
Hey, Jumana, you mentioned the central bank commentary, and clearly the inflation risk is still weighing on markets. And you can see here in Asia, it's looking a little bit mixed, but still under pressure, even as we see the pullback in oil. That's giving a bit of relief to the Kospi, just marginally in the green today. But mostly here you can see the Hang Seng is also down. Japan, by the way, is closed for a holiday. Hang Seng is partly also because we have Alibaba reporting earnings today. Huge disappointment. We're talking about both the top line and bottom line missing estimates, a 67% decline in net income. And that is really driven by the huge promotional spending on the quick commerce segment as Alibaba enters into this battle with Meituan. And so that's the revenue picture for Alibaba, even though its cloud computing revenue actually is doing very well, but there's still concern around the path to monetization. So here you can see all the big tech names all declining today. So we have two of the biggest stocks on the Hang Seng, Tencent and Alibaba, reporting earnings this week, both disappointing to the downside, and that is putting a lot of pressure on the Hang Seng Tech.
Min, thank you so much, Min Lo in Hong Kong. Well, our top story today, the leaders of the U.S. and Israel have sought to reassure investors rattled by damage to major Persian Gulf energy facilities. Israel says it will no longer target energy infrastructure after rebuke from President Trump. And Prime Minister Benjamin Netanyahu says Israeli forces will help the U.S. attempt to reopen the Strait of Hormuz.
The death cult in Iran is trying to blackmail the world by closing a key international maritime route, the Straits of Hormuz. It won't work. Israel is helping in its own way, and intel and other means, the American effort to open the Straits of Hormuz, rather.
For more, we're joined by Stuart Livingstone-Wallace, our executive editor for MENA in Russia. Stuart, well, about 24 hours ago, President Trump put up that post distancing the U.S. from the Israeli airstrikes on the South Gas Pars field. And of course, as we were discussing throughout the course of the day yesterday, the retaliation from Iran came very swiftly, targeting key infrastructure sites in the Middle East. But it seems as though overnight, both President Trump and the Israeli Prime Minister are trying to downplay the possibility of future attacks on key energy sites in Iran.
Yeah, exactly. I mean, they are trying to de-escalate that particular point. I would say that it's probably not working so far. I mean, as you saw coming across the wires a short time ago, you had Kuwait saying that it had one of its refineries attacked by a wave of drones, and that set off fire. So if they are trying to de-escalate, there's no evidence yet that Iran is responding in kind. And that will continue to have this knock-on effect that you've already seen in the energy markets. I mean, it is really quite profound by every measure, both at the crude oil level, at the gas level, but then down into refined products, and that is spreading across the world. So if you look, for instance, at the US retail gasoline price, it has risen every single day since this war began.
And Stuart, we got a little bit more color from QatarEnergy as to the extent of the damage that was sustained. Talk us through it.
Yeah, I mean, it looks pretty bad. I mean, they're sort of giving a 3 to 5 year time frame to be able to get all of that back. So clearly, I mean, these are incredibly complex bits of kit. It's not as simple as sort of replacing a pipe. They're very, very complex bits of machinery. So it's understandable it's going to take some time, but I think that has ramifications again for the entire global economy because it is such a gigantic producer and supplier to countries all around the world, and it's very important. Not only that, but it was, in the middle of doing an expansion in terms of its capacity and therefore becoming a more important player in the world. So what does that mean? I mean, in effect, it leaves the remaining players, in a much stronger position in terms of being able to grab market share. But there's real questions there about whether there's enough other capacity in the world to make up for that lost supply. And as a consequence, again, you're going to see this domino effect. What exactly is Europe going to use to power itself in the coming years? Is it going to be nuclear? Is it going to be coal? There doesn't appear to be enough gas out there necessarily to be able to supply existing demand. So it's going to have some very profound implications for power generation, I think, across the world.
Stuart, thank you so much. Stuart Livingstone-Wallace, our executive editor for MENA and Russia. Well, let's continue the energy conversation. To discuss further, joining us is Christof Rühl, Crystol Energy Global Advisor. Christof, it is interesting that, again, there's been an attempt to sort of de-escalate people's concerns or investors' concerns about the disruption in energy markets. But at the end of the day, I mean, the IEA even said it. This is the largest disruption that has ever happened to oil markets in the history of them tracking it. How do you see this moment, and how much are markets and oil markets adequately reflecting the moment that we're in right now with Brent at around $107?
Good morning, and Eid Mubarak to you. So, I think that what we are seeing here is really a problem of trying to stop the escalation in one way or another. The most interesting part of what is playing out now is not whether Israel did it alone or the US helped them, or the attempts of Netanyahu and Trump to sort of downplay future attacks on the infrastructure. To me, it is the clear recognition that Iran is able and capable and willing to not just shoot random salvos at its neighbors, but to target particular pre-selected energy products in a tit for tat. And that indicates to markets, I think, that this asymmetric warfare they have engaged in can be sustained for a long time. And together with its noises about rejecting a possible ceasefire a la Gaza, and together with this fact that it becomes every day more difficult for Netanyahu and Trump to retreat from the situation, this indicates more trouble on the horizon. And for oil, gas, and energy markets in general, it is the prospect of further disruptions which is the most important driving factor, not an actual shortage right now. There's no queues. There is no lasting damage to global gas supplies from this attack, not a big one if you do the numbers. And it's the fear that this spirals further out of control, which is the dangerous part here also for the global economy.
Christof, let's say there were a ceasefire announced. There was to be a ceasefire announced tomorrow, and the strait gets reopened. Not saying that this is realistic at this point, but if that does happen, how do you think the energy markets would react? Because as you say, it seems as though we've moved away from just short-term disruption to flows to perhaps investors now pricing in longer-term physical disruption and higher geopolitical premium in the region.
So far, every day has brought more negative surprises. If that turns, and if you take your scenario and peace breaks out tomorrow, I think we are still on the good side of the equation, in the sense the damage to international gas markets. Qatar said it's about 18% of its LNG capacity, production capacity, which in turn, Qatar's capacity is 20% of the global capacity. So that's a loss of about 4%. That can be dealt with. Oil markets have been in good shape before this attack happened. Strategic storage is high everywhere. Chinese storage is very high. Oil on the water from Russia and Iran is very high. The strait opening tomorrow, no lasting damage to oil production facilities as far as we can see. No Houthi attacks in the Red Sea and the East-Western pipeline, Saudi Arabia. All that would equate to the storm blowing over pretty quickly and oil markets returning to a situation of general oversupply, which is the situation they had before these attacks.
Yeah. And how easy is it going to be to find alternative supplies? And this is to what my colleague Stuart was saying earlier. There's going to be perhaps a scarcity of supplies available, especially when it comes to LNG. Does this mean that eventually we will have to end up in a demand destruction scenario for not just consumers, but for industries as well?
I think at the moment, in purely energy and economic categories, we are still before this Rubicon, so to speak. If it happens that tomorrow the supplies are being restored, I don't see lasting damage either in global gas markets, where it will take some time for prices to come all the way back to where they were, or in oil markets, where it will be very fast, this adjustment. Then, of course, it depends what happens to sanctions, what happens to future production. It is really the fear of the unprecedented. We never had a supply disruption like this, but for now it would still be short. It's the fear of this being prolonged, the fear of supplies being meaningfully disrupted at production facilities by physical damage damaging them, which drives these oil spikes. And you can tell that actually compared to the winter of 22-23 when Russia attacked Ukraine, we are still by several degrees, orders of magnitude below the price spikes which we have seen a few years ago in that situation. And the reason is that A, energy markets were well supplied before it happened, and B, the physical damage is still limited, and C, a simple straight, a joke point, if in your assumption it's open tomorrow, the problem will be, the immediate problem for prices will be gone, and what remains are political problems. And that's why I'm saying if you only look in economic and energy categories, we can manage it. If we add to this military political dimension, it gets horribly difficult.
Yeah. Christof, let me ask you something else. I think many people were surprised to hear the Treasury Secretary Scott Bessent say that they could move to unsanction some of the Russian oil that's already floating on water yesterday. Seems quite paradoxical given the war is still going on. And I just wonder, number one, how much of an impact that could have, and number two, are Russia ultimately the ones that are benefiting the most from this energy crisis?
Well, number one, the US has almost exhausted the arsenal of stopping prices from rising, given this degree of uncertainty. If the strait isn't opened and this uncertainty of physical damage is not removed, they can unilaterally throw on the market some of their strategic stocks. They can promise to intervene in future markets, which will meet with a huge degree of skepticism by Wall Street. And they can make promises of desanctioning Russian oil, which they already have for all intents and purposes for the next 30 days by allowing it to return and to be imported into India. So there isn't much they can do. On the second part of the question, there's no doubt, absolutely no doubt, that the biggest winner of all of this is Russia. Russia has a lot of oil parked on the water after sanctions were tightened and they couldn't export it to India anymore. Before that, it went to China, India, and Turkey, basically. That oil is now being released, and so their supplies are increased from Russia. They find it easier to enter that in the global markets at a price which, since the attacks of Iran, has increased by 50%. Now, this hits Russia in a situation where they had just decided to sequester their budget and cut their expenditures by 10% because oil prices had come down nicely and because sanctions finally had tightened sufficiently for them to feel the pinch. And in that situation, this must have been a huge relief valve. And yes, it's true, Putin is losing friends at a rapid clip in Venezuela and Iran, but on the economic side, they are the single biggest beneficiary of this by far.
Christof, always good to chat to you. Thank you so much for joining us. Christof Rühl, Crystol Energy Global Advisor. Well, coming up, plenty more ahead. Stay with us. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jumana Bersachi in Dubai. Now, tensions between the U.S. and Japan over the Iran war remained evident as President Donald Trump hosted Prime Minister Sanae Takaichi, even as he praised Japan for answering his call for support in the effort. Bloomberg's Tyler Kendall recapped the event outside the White House.
As Japanese Prime Minister Takaichi visited the White House here today, President Trump said that Japan is, quote, stepping up to the plate, unlike NATO allies, though it is clear that tensions remain. It's not immediately clear what steps Japan is taking when it comes to the conflict in Iran, though President Trump said the pair of leaders will discuss Japan's mine-sweeping capabilities in dialogue behind closed doors. The Japanese Prime Minister saying she had brought to the U.S. concrete proposals to help calm energy markets and condemned the closure of the Strait of Hormuz, which data shows 90% of Japan's crude oil imports flow through. Uncomfortable circumstances were on display, though, when a reporter asked President Trump why the U.S. hadn't informed allies about the war, and he answered, "Who knows better about surprise than Japan," in reference to Pearl Harbor. This White House visit is a chance for the two countries to strengthen economic ties, and a major topic of discussion will be the $550 billion pledged investment fund established as part of the U.S.-Japan trade truce. Bloomberg News now reporting that includes a new $40 billion planned investment in nuclear reactors in a bid to stabilize energy prices. China also looms large over this White House visit, considering that this trip was planned before the conflict in Iran started and was designed as a way for the two leaders to touch base before President Trump travels to Beijing. That planned meeting is now delayed, the president saying about a month or so from now. At the White House, Tyler Kendall, Bloomberg News.
Bloomberg's Tyler Kendall there. Well, coming up, Nigeria's Dangote refinery sees a surge in fuel demand amid the Iran war. More details next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jumana Bersachi in Dubai. Jay Staley's wife has filed for divorce from the former Barclays chief executive, who was banned from the UK financial industry over his relationship with Jeffrey Epstein. Deborah Staley's divorce filing comes after Jess Staley publicly testified about being unfaithful to her years earlier with one of Epstein's staffers. Wall Street lending giants could get relaxed capital requirements under proposals unveiled by the Federal Reserve. The changes could potentially unleash billions of dollars for lending, share buybacks, and dividends. The plans are subject to a 90-day public consultation, but if approved, would represent a major win for the industry. Sources have told Bloomberg that President Trump and top Justice Department officials support a new bid to investigate Fed Chair Jerome Powell. Last week, a judge rejected subpoenas issued to the central bank, which prompted U.S. Attorney Jeanine Pirro to say she would appeal the decision. The investigation is related to the Fed's $2.5 billion renovation of its headquarters and testimony that Powell gave to the Senate. Alibaba's U.S.-listed shares slumped after reported third-quarter sales that missed estimates. Sluggish growth in its core e-commerce business dragged on earnings, while intensified competition in food delivery also crimped profits. Alibaba's cloud and AI units saw the fastest growth. The company says it aims to quintuple revenue from those businesses in 5 years to $100 billion annually. And a quick look at equity futures. Things are pointing towards the green today. Some attempts at de-escalation, I would say, from leaders, but at the same time, the intensity of the attacks both ways continues over here in the region. We'll talk more about that. But coming up, Vontobel joins us with their market outlook as the U.S. and Israel try to reassure investors rattled by the damage to major Persian Gulf energy facilities. That's next. This is Bloomberg. Good morning. This is Horizons Middle East and Africa. Our top stories this morning. Oil prices retreating as the U.S. and Israel try to ease concerns over the war with Iran. Prime Minister Benjamin Netanyahu says Israel will avoid future attacks on Iranian energy facilities. QatarEnergy says the strikes on its Ras Laffan site will cost about $20 billion a year in lost revenue and take up to 5 years to repair. And high energy prices are reviving fears of a global inflation shock. Bond investors worldwide now rushing to price in higher interest rates, complicating the path ahead for central banks. Well, it's just gone at 9:30 a.m. across the Emirates. I'm Jumana Bersachi in Dubai. Eid Mubarak to our viewers who are tuning in. But if you've got the day off, then hopefully you're enjoying it somewhere. Let's take a look at how global markets are faring as we head into the final trading day of the week. And we're seeing a bit more green on the board today. S&P yesterday ended the day in the red, but at one point we were down 1%, ending though the session down 0.3%. Attempts, I would say, out of President Trump to sort of de-escalate the situation over here in the region. But I will tell you, just even anecdotally, there is still ongoing attacks launched from both Israel into Iran and Iran retaliating against GCC states. So things on the ground different, perhaps, to some of the framing that's coming through elsewhere. But S&P futures up 0.1% this morning. European markets also seen opening up in the green, up 0.6%. This after a major pullback yesterday, down 2%. Again, lots of questions there about the ramifications of this energy squeeze, the gas squeeze, the fact that QatarEnergy have now actually said that about 17% of their capacity is going to be taken offline. That is going to have huge reverberations for Asian economies, also for Europe as well. So we saw that being priced in yesterday. Brent is slipping somewhat this morning, down 1%, but still trading up at $108 or just below that. One of the interesting announcements that came through yesterday from the U.S. Treasury Secretary Scott Bessent, saying that they're looking to unsanction some of the Russian oil that's already available on Iranian oil, rather. They're looking to unsanction some of the Iranian oil that's already on waters. So another measure that's being put forward by the U.S. to help bring down prices. This, as we continue to focus on energy infrastructure damage, alongside the fact that the Strait continues to be effectively shut. And then gold this morning up 1.3%. But take a look at where we're at. We're down to 4,700. It has not been a pretty week or pretty couple of days for precious metals or industrial metals. And then switching over, I did mention the knock-on effects that the energy crisis is going to have on other economies. The macro is interesting because right now what you're seeing is the front end of US, Europe, UK, all repricing quite significantly over the course of the last few weeks. Take a look at 2-year gilts, up 80 basis points this month alone. The US up 30 basis points, Germany up around 50 basis points to account for what is expected to be a higher inflation profile in the coming months. And this is actually something that was explicitly referenced by the Bank of England yesterday. ECB sort of holding the course, saying steady, but ultimately investors now accounting in for that inflation shock. And switching over, just to point out that because of that, there are rate hikes now priced in, about 3 rate hikes priced in to the 2026 Bank of England curve. The ECB just a little below that, around 63 basis points, and then the Fed's essentially flat now. So all of the cuts that were priced into the Fed curve have now been unpriced. So the Fed curve is flat for 2026. Now, we spoke about Asia, Europe, but Bloomberg has learned that African nations are scrambling to secure fuel from Nigeria's Dangote refinery as war in the Middle East disrupts supply. The refinery is now seeing a massive surge in demand from countries like South Africa and Kenya to prevent local energy shortages. For more, our chief Africa correspondent Jennifer Zabazaja joins us from Johannesburg. Yet another perspective on how this global energy crisis is affecting specific refineries. And in this case, we're talking about the Dangote one. I guess the question is, does Dangote actually have the capacity to fill the gap that's needed for many of these African economies that need it?
Exactly, Jumana. Dangote's refinery has only been operational for just over 2 years, and they do have quite a bit of refining capacity. But if we think about the extent of what African nations need at this point in time, potentially it's not going to be able to fill the gap. So at this point in time, the refinery is able to produce about 650,000 barrels a day, and around 75% of those are reserved for Nigeria. So there is a limited amount that can actually be exported. We actually heard from Dangote, who spoke to The Economist, and said right now it's not about pricing, it's about availability, just underscoring how the situation continues to evolve. But Bloomberg reporting does suggest a number of nations are trying to reach out to Nigeria to see what is available, but not just Nigeria, also a number of stakeholders, just to fill the gap until we get some clarity about where things are headed at this point.
And are there signs that the war is already impacting the continent, Jen?
There's quite a few signs, Jumana. I mean, you've been talking extensively about the energy situation, which is perhaps most acute here on the continent and in East and Southern Africa, which really relied on the Middle East for imported fuel. A number of countries, which we've reported on, do have some emergency reserves, but they don't actually have this refined fuel. And so that is really the concern. And it's not just that, Jumana. There are also structural structural weaknesses that are being exposed as this war continues on. We do know South Africa has about 8 million barrels of strategic crude oil stocks. Virtually none of that is fuel reserves, We've also been hearing from miners like Exxaro who are talking about potential knock-on effects. Potentially we see more demand for alternative fuels. They're actually predicting that potentially we see coal prices going higher as a result. And not just that, they're also concerned potentially about the shipping costs and the freight costs that come with higher fuel costs. And so this is really being spread across the board, across the energy supply chain, and African leaders and governments are trying to not cause any sort of overreaction, but we are already seeing some prices, like in Somalia, for gas and for fuel continuing to rise. So again, time will really tell where these alternative sources are going to be for a number of these countries for their refined products.
Jennifer, thank you so much. Jennifer Zabazaja, our Chief Africa correspondent. Now, emerging market assets are under pressure as hopes for a U.S. interest rate cuts evaporate and as conflict in the Middle East weighs on sentiment. Joining us is Anne-Laure Kiechel, founder and CEO of Global Sovereign Advisory. Anne-Laure, really good to have you with us. Maybe let's just start with a broad perspective of just how much of a shock the Iran war is going to constitute for emerging market economies, and if you have changed your growth outlook for many of them on the back of it.
Yeah, good morning. Look, first of all, it's very, very difficult to have a diagnosis right now because obviously we're still very early days and we are seeing, and you spoke about it actually minutes ago, the volatilities that we are seeing in the prices of oil or other commodities, right? So for sure, I mean, those economies and the emerging market economies will have issues, and some of them have started to have issues if the oil price remained high. If the gas price remain high, I think gas, we may talk a lot about oil, but gas definitely is one to be looked at. And also there are other commodities that are being an issue, right? Because typically on the fertilizer front, which is extremely important because we are during the time of the year, right, where obviously fertilizer needs to be used, and a lot of the fertilizers goes and comes from the Gulf region, and the prices of those have already started to go higher, which of course is also going to create a shock and could also have repercussion around the food industry. So I guess what I would like to say is that still it's early, so it's difficult to know if it's going to be something very temporarily that is going, of course, to be a hit on those economies, but it could be managed because it will be short, or if those are going to have lasting effects, typically because oil or gas or other commodities are going to be higher on the long term.
Yeah.
Be honest with you, I think we're going to see those prices higher.
Okay, so you think that we're going to see prices higher in the long term. The closest parallel that we can draw is what happened back in 2022 and also around COVID as well. And back then, you saw governments step up with these massive spending packages to help bolster their economies. And in many sovereign countries around the world, these fiscal levels haven't quite recovered. So we saw a shooting up of debt, and they've really struggled to bring them back down again. Are we going to see wave 2 of this, do you think, this time around? Are we going to see governments forced to spend more to help deal with this energy crisis?
Yes, it already has an impact, right? Because a lot of those governments have subsidies with regards to energy, right? So those subsidies are already in place. So you're not already talking about new subsidies or new measures that they could take. You're already talking about the ones that are in place and that obviously are influenced when the price of energy goes higher, right? So indeed, it's already impacting the budgets. You're absolutely right to say that the budgets of those states are already, I would say, not fragile, but they're more constrained because of multi-shocks, because of the COVID, because of the war in Ukraine, so that have been one after the other, with increasing debt level that we've seen. And indeed, there hasn't really been time to recover or to reconstitute room to maneuver and fiscal room to maneuver. So this, for sure, is one cause of concern. And if you ask me, I don't think the market has priced this in any way, shape, or form. Because if, for example, you look into the bonds in the emerging markets, for example, in Africa, Africa bonds, I mean, you've seen a little bit of a hike, right? But nothing to the extent that would actually signal a true issue, right? So I think on this, the market is being, for the moment, I think, on the waiting line, but has not overreacted or has not really 100% priced something that would be a lasting effect.
Yeah. Okay. Interesting perspective there. Are there any countries, at least, on your radar, and maybe looking specifically to the African continent too, that stand to benefit from this? So we're just talking about the huge incoming demand that the Dangote refinery is getting in Nigeria.
Yeah, well, look, I think some of the country, like indeed Nigeria, is one that could potentially benefit, but typically Egypt could also benefit, and Algeria could also benefit. So Egypt is a more complex case because, I mean, there are pros and there are cons for Egypt, in the sense of Egypt could also be under pressure. But if you think about what they could do, I mean, they could become, or they could at least increase their influence on the fertilizer front, right, which obviously is going to be very needed, and they could substitute themselves to some other players that are, for example, in the Gulf region. I mean, it's a slow process, but still, it could be something that could be good for them. Also, when you think about some exporters of commodities, typically I'm thinking of the likes of Zambia. It depends a lot of the copper price, of course, but this could end up being beneficial. So you're going to have the traditional ones that depends on oil and are oil importers that, of course, are going to have some issues. You're going to have the oil exporter that are going to benefit out of it. So this is the usual things that happen in such cases, but I think you're going to also see effects in other sectors, typically in the fertilizer sector, that is going to be one that is going to benefit some of those economies. But if I'm doing it super simplistic, the African countries that are on the eastern side, I mean, are going to have more issues because of stronger ties to the GCC. South Africa is also one to follow closely, right? They do have already signaled some issues with regards also to their energy reserves. They, of course, have capacity to rebuild, but I mean, this is something that they've basically said. And so far, countries from the WAMU region, for example, are a little bit more immune to those, but obviously, if the crisis was to continue much longer, I mean, they will also have issues on the line.
Anne-Laure Kiechel, thank you so much for joining us, founder and CEO of Global Sovereign Advisory. Well, trading in equities is choppy heading into the weekend, while oil prices retreated as investors weighed efforts by the U.S. and Israel to ease concerns over the Iran war. Joining us now is Dan Scott, Vontobel CIO and Multi Asset Head. Dan, good to have you with us. The question that I've been asking myself all week is whether equity markets, and specifically U.S. equity markets, are simply being too complacent about how bad the situation is on the ground over here in the region, and the real amplification in terms of, the energy sites that were hit yesterday, the long-lasting damage that could have globally. Are U.S. stock markets being too complacent?
Hi, Jemana. Thanks very much for having me on. It's a very treacherous situation, I'd say, right now, because as an asset allocator, you need to decide whether you want to recalibrate your economic outlook, whether you want to have a base case scenario where you feel that energy prices are up and remain higher for a longer term, and then the economic outlook completely changes as to whether you think that this is just going to be a situation that resolves itself in the short to medium term. And I think right now what the markets are telling you, if you look at how relatively well behaved they are, that the hope is there that actually the Strait of Hormuz opens up. And really it is that energy bottleneck that is the most pertinent for markets, because it then has, as a function, of course, an impact on your inflation expectations. And as you were pointing out before, also a recalibration on, where you expect rates to go. And so the U.S. is seen as being fairly shielded, at least because it can supply itself in terms of energy, but prices do go up, because energy prices are set globally. And so that really is going to be a question whether you manage to work through that inflation as being something to look through, or something that's actually going to feed its way through and have a longer-term impact on CPI, and whether that means that then you need to recalibrate your expectations for rates in the U.S. And I think the market has done some of that. Nonetheless, we're trading, not so far off all-time highs on U.S. markets. And the big hit clearly is not the U.S. The big hit has been in Europe, which has a lot more energy dependence.
Yeah, so let me talk to you about that. And yesterday we had two key central bank meetings. We had the ECB and the Bank of England. The market had different reactions. Well, also the tone that came out of those central banks differed a little bit. The Bank of England seemed to be more alert and indicated that a hike could be a possibility. ECB signaling that they're going to stay steady the course. What do you make of the differing attitudes that the Bank of England and the ECB had to this inflation shock yesterday?
Well, I think the two have very different underlying economies and situations that they need to deal with. In the UK, the inflation picture has been a bit stickier. So the UK does have this trickier situation where they have stickier inflation, but at the same time, they have an economy that's really going to struggle with rate hikes. So they need to move on the inflation front. For the Eurozone, doesn't really have an inflation problem. There's not really an issue with inflation in the Eurozone. There's no real need to hike, unless, of course, you have an energy situation here that does move inflation higher. And the Eurozone economy is fine on hold here for the time being. So I think there it's really a question of, the cost of gas, in particular, imports into the Eurozone, and whether that has then a knock-on effect onto inflation. So that's probably why you have a differing view from those central bankers.
Yeah, I also wonder whether investors this time around are quick to price in a hiking cycle because of what happened around COVID, when central bankers were telling us that inflation was going to be transitory and, of course, embarked on a series of hikes much later than they should have. Do you think this is what's happening right now with market participants to account for that possibility?
Well, see, the difference between central banks going into hiking mode and central banks staying with relatively easy monetary policy, maybe even further cuts in the U.S., which is what we were pricing before, is that positioning is completely different. And I think the market does not want to turn its positioning upside down here and go into risk-off mode. You can see that there has been some liquidity taken off. There has been some change or some profit-taking, rather, in those sectors that have high valuations. But otherwise, it's really mainly wait and see, because the outlook still remains for a global economy that's doing quite well, for a U.S. economy that's growing, close to capacity, and a Eurozone economy that's also going to look to be growing at 1.5% approximately GDP. So the outlook is fairly risk-on, or had been fairly risk-on going into this event. And now if we turn things upside down and look into monetary tightening, that really does turn things upside down in terms of asset allocation as well. And so far, we haven't seen those moves. So far, it looks like people still want to maintain an element of risk and look to opportunistically, gain when markets snap back. But we do really need an opening of the strait again in order for that to be a possibility.
Yeah, it all boils down to the strait. Okay. Dan Scott, thank you so much. Always good to talk to you. Thanks for joining our show. Vontobel, CIO and Multi Asset Head. Well, Dubai has long sold itself as a safe haven in the Middle East, but Iran's unprecedented strikes on U.S. partners across the region are now putting that reputation under pressure. Bloomberg Originals has been investigating how Dubai's model of stability is being challenged. Here's a preview.
These attacks were unprecedented. We could not have imagined this scenario actually playing out.
Most airports and airlines in the region are affected.
Drone has hit a residential tower overnight in Dubai. It sparked a fire and residents were forced to evacuate the building.
This conflict has come to the doorstep of a territory that many perceived to be one of the world's top safe haven territories.
That perception was by design and helped attract both money and talent. The strikes threaten more than lives and infrastructure. They're testing Dubai's model of stability and the image it wants to project.
Iran's formerly supreme leader, Ayatollah Khamenei, is dead. We've already won in many ways, but we haven't won enough.
Thousands of deaths across the region have been reported in the war begun by the US and Israel. Iran's wave of retaliatory strikes targeted US allies, prompting the UAE to prioritize safety above all else.
Iranian strikes have hit airports, military bases, even data centers.
The UAE has seemingly defied what many assumed would be an existential threat. It's navigated peril before, but with war on its doorstep, can it do it again?
And subscribers can watch that full documentary now on the terminal or our website at Bloomberg.com. You can also find more from Bloomberg Originals on their YouTube channel. Well, the war in Iran has once again presented Donald Trump with an intractable dilemma. The U.S. president needed to calm energy markets and turn to social media, posting that the U.S. had no advanced knowledge of Israel's plan to attack Iran's biggest natural gas field. However, in Israel, officials insisted Trump knew. For more, our news desk managing editor Jill Deses joins us. So, Jill, just talk us through the options that President Trump is facing in this war. And of course, he's faced now with, what has expanded into a regional war. His Gulf allies are irate that they have been targeted in such a fashion. And of course, the economic costs continue to mount.
Yes, that's right. And hi, Jumana. Hope you're staying safe. Look, I think at this point, you've got kind of a fork in the road when it comes to the options that the Trump administration and Trump himself could ultimately pursue. You ultimately see an avenue where there is a continued escalation. That's one thing that he can continue sort of pressing Iran in this war. We know that the Pentagon is apparently attempting to secure loads more money and to sort of support that military firepower. Of course, though, as we've seen over the past couple of days, that kind of escalation does threaten to completely upend global energy supply. Obviously, those attacks that from Iran in response to those Israeli strikes on energy supplies in Iran, the other attacks obviously led us to a situation where there were very, very enormous concerns about oil crunches. So that is one option, but obviously one that may lead to that further escalation, not just within that energy supply issue, but also military conflict. The other thing that Trump could do is, potentially look for an off-ramp. He can say, look, we've achieved what we set out to do. We've taken out several high-profile Iranian, military leaders, intelligence leaders. So that's, one thing that he can ultimately point to there. There is, that element of that's been upended in that way. He can say that, we've destabilized certain bits of, the Iranian nuclear program or what have you, sort of like point to things that he might portray as a win in the situation if he's looking to ultimately back off of that conflict. The trouble with that exit ramp, though, Jomana, is that, one could argue that Tehran is actually in a fairly strong negotiating position at this point. So, obviously, if those retaliation strikes on things like that Qatari LNG field, UAE, those energy supplies are enough to really kind of rattle, Trump and Netanyahu, that does kind of suggest that that may be difficult as well. So it's some tough options here for Trump.
And there have been reports overnight suggesting that the Pentagon are seeking $200 billion in additional funds from Congress. How likely is it that that's actually going to get through, Jill?
Yeah, that's an enormous amount of money, Jumana. I think that that's one thing that, you'd have to look for, ultimate approval, a congressional approval to actually achieve. At this point, the other thing, too, that I think is really weighing on the minds of political leaders in America, at least, is they've got this really important midterm election in the fall here. So when you're talking about all of these international incidents that the United States is involved in, there's very much a domestic issue for them to pursue as well, which is that Americans don't want to see their prices go up at the fuel pump. pump. They don't want to deal with rising inflation. This is something that Trump himself championed coming into office. It was a successful part of his campaign, was convincing voters that he was there to not get involved in a bunch of prolonged international conflicts and to also bring down their cost of groceries and gas and such. I mean, there could be an argument there that other political leaders in the United States that may be responsible for approving those types of funding or saying, we don't want to be involved in a protracted conflict. So really difficult situation for the U.S. to kind of sort of navigate here, but that's ultimately, a lot of the strategies that are at play.
Bloomberg's News Desk Managing Editor Jill says, thank you so much. Okay, I'm going to do this super quickly. Let's just take a look back at the week and how some of these key assets have fared, because we did see equities trade more cautiously, but for the week, the S&P is actually down only just 0.4%. It's not that much given everything that's happened. The Stock 600 down a bit more, significantly down 2% on back of the gas knock-on effects. Asia Pacific actually up in the green. Switching over though, oil, that's the one that everyone's been watching this week. And for the week, we are higher to the tune of 3.3%. European gas futures up 23%. So that was your look back. Thank you for watching and Eid Mubarak.